All right, let's go ahead and begin. Welcome everyone to tonight's webinar about sustainability reporting in the EU. My name is Dr. Michael Willis, and I am a Management Practice Associate Professor at the University of Cambridge Judge Business School. I'm also the director of the Executive Master of Accounting program. And this talk tonight is kind of a teaser trailer for an entire module in the Executive Master Accounting program on sustainability reporting. It's just one of the topics that we cover in the program. And I'll just take 60 seconds and introduce you to the program because it's quite different than other programs, and it's quite different than what most people think of when they hear a Master of Accounting program. So this is an executive master of accounting. It's a leadership focused program for people with experience in accounting, finance, some related or adjacent fields. So it's not sort of technical debits and credits training. It's designed to complement all of that sort of postgraduate training in accounting and finance that most people receive. The program's part-time. It's delivered in 8 residential weeks in Cambridge, spread over 2 years. So students visit Cambridge once a quarter for a week at a time. And in between those visits to Cambridge, they're engaged in online learning activities. And the topics that we cover are really the kind of thing that leaders in accounting and finance really need to come to speed on to contribute in their organizations and in the world. So things like AI and machine learning and data visualization, more human focused topics like change leadership, interpersonal dynamics, things like sustainability, which we're talking about tonight, strategic performance management. All of these are make up the curriculum of the program, which is designed to support career paths to things like a CFO track or a partnership track, policy, leadership, regulatory career paths, sustainability related paths, more data oriented career paths. Most of our students have about 10 years of work experience. It's the average. There's a range. Some have less, some have more. And the program is growing. So we're looking for quality applicants from around the world to join the program this year as we continue to grow. And I'll say more at the end about how to engage with us and learn more about the program. But the topic tonight, again, is sort of the brief introduction to a topic that I teach on the Executive Mac program. Now, as we go along, if you have any questions, please just type those in the Q&A box. I'm going to do my best to keep an eye on those questions, and feel free to ask them as we go. And I'm happy to take those, and also we'll leave some time at the end for any other questions that you might have. So let's jump into the topic. Okay, well, when we think about sustainability related information, what's sort of out there in the world related to sustainability? Well, we have some really big picture, sort of global level data. We can measure the amount of CO2 in the atmosphere and other greenhouse gases. We can measure temperatures. We can measure air temperature. We can measure temperature of the water. We can measure chemical attributes of the water. We could measure, we could measure things like, we could measure things like energy mix and energy investment, the use of solar, the use of wind, prices for these things. But what about sort of firm specific sustainability related information, the kind of things that a company would disclose publicly about sustainability? This fits into a sort of 3-wave framing of dealing with sustainability related matters. Now, this thinking comes out of the environmental world. How do you deal with environmental problems like pollution or like climate change? But you can think of it in the context of broader sustainability issues. Still makes sense. So the first wave of trying to deal with these things There's direct regulation. You can directly regulate pollution or greenhouse gas emissions or whatever. Um, that doesn't always work, and it's quite difficult to get that off the ground in a global way. So the second sort of second wave of dealing with sustainability problems and challenges is market-based approaches. So we have emissions markets and emissions trades and things like that, and some that can work to some extent to mitigate some of these sustainability problems. The third wave of trying to address these challenges is disclosure mandates. The idea being that if firms are required to make sustainability related disclosures, so they could take the form of more financial disclosures that are just intended to inform investors and creditors about financial risks. But they could also, even if they're principally intended to do that, they might also have an effect on firms' behavior. And sometimes these disclosure mandates are specifically intended to get firms to change their behavior and basically mitigate their own externalities. The disclosure provides this accountability mechanism. So we can think about this information as a good, and we can apply sort of economic reasoning and thinking to this information good. There's a demand for firm level sustainability related information out there. Who wants sustainability related information and why? Well, we can think of, I'm sure, a number of entities that would like sustainability related information about individual firms. So, certainly, we know that equity investors would like this information. There are sustainability related risks, for example, that are financially relevant to measuring an investment risk and investment return. So that's quite relevant for equity investors. But of course, not all equity investors are the same. We may have equity investors that might be focused on impact or might desire to build a portfolio, optimize a portfolio on other attributes besides return, including things like climate or other sustainability matters. Um, we can think of other capital market participants sort of similarly. Banks and lenders might also want sustainability related information. You could think about a bank, for example, might make loans to agricultural firms. And if global temperature increases a certain amount, then those firms might not be able to grow the crops they're currently growing. So that's quite a big risk potentially to their portfolio. That's a sustainability, climate related risk that banks would like to know. But beyond that, there are other stakeholders as well that would really like information about a firm's sustainability matters. So customers might want to know this. Governments certainly would want to know this. Regulators, um, NGOs, activist groups would want to know this. So there's a strong demand for firm level sustainability related information. Okay, well, if we're thinking of information as a good, it's got demand. Well, what about the supply? What's the supply of firm level sustainability related information? And that's really the topic of tonight, is what's changing in that area that's going to be driving new supply of sustainability related disclosures. Now, right now, the current state of firm level disclosures is not very mature, and we're going to talk more about that in just a moment. But some key questions when we're starting to think about the state of information that's out there is, how's it produced? Where does it come from? How are firms preparing and disclosing this information? And the most important question, arguably, is can we trust it? Can the stakeholders who want to use that information to support a decision trust the information that they have? If they can't, then the information is of limited utility. So we are in the early days of a dramatic increase in the amount of sustainability related information, firm specific sustainability information that's out there. And it's about to ramp up very aggressively next year, led by the EU, which is really the topic of tonight's talk. But so what? So what can we expect to happen? And how is this going to change the world as we know it? Now, spoiler alert, I don't have a certain answer to that question. I don't think anyone does. But as we start to work through what's changing on the supply side, I think we might identify some reasonable ways that we can see things changing and some interesting things that we might expect. Whether we find ourselves on the side of someone consuming or reading or acting on sustainability information that's disclosed by a firm, or maybe we find ourselves on the production side of a company where we're actually preparing or contributing to sustainability reporting efforts or providing assurance around sustainability reports or wherever we fit in that sort of ecosystem. I think understanding what's changing will sort of help us get ahead in that process. Okay, so back to the current state of play. So kind of what's out there right now. Let's just consider the very sort of maybe the most fundamental metric that's out there, at least related to climate change. Now, of course, the sustainability world and the sustainability information world is much larger than just climate related matters. But that's an area that's been addressed most urgently by governments and companies around the world. So let's think about scope one greenhouse gas emissions for now. Firm level scope one greenhouse gas emissions, and scope one emissions would be all of the greenhouse gases that a company emits in its production process. Okay, not scope two. Scope two is the emissions from the energy that the company purchases and uses. This is the company's own operations emissions. Okay, now again, we're not hyper focusing on climate or on scope one or even greenhouse gases because the picture is much larger. But let's just think about this very, very fundamental piece of climate related information. Well, what we might do, this is actually from some research that came out fairly recently in Science. Believe it or not, there's an accounting paper in Science, and it's looking at trying to quantify carbon related damages. So they use this equation here called corporate carbon damages. It's trying to hang a dollar, a currency amount on each company's scope one emissions. And they do that by taking annual scope one emissions, so a year's emissions, and they multiply by some dollar amount that they call the social cost of carbon. So this is a certain amount of US dollars per ton of CO2 emitted. And there's been different estimates used by different agencies around the world. I think they went with 150 US dollars per ton or something like that. Okay, so that gives a dollar cost to the carbon emitted by a company. And then if you divide that by operating income, that's meant to sort of scale by some measure of production, then you get this measure of how much damage, sort of the externality quantified by a company's scope one greenhouse gas emissions. And if we do this, we can do some kind of interesting calculations, sort of just descriptive analysis of some of these numbers. So this is now corporate carbon damages by industry. Okay. And so you can see, that there are some industries with very little scope one emissions, like banks. They don't have much they just have some buildings, right? That's all buildings and some servers. They don't have any heavily emitting stuff. But energy, of course, that's very a heavy emitter. Materials, that's quite large as well. Transportation and utilities, okay, and food, beverage, and tobacco. So those are really high emitting industries. So we can see which industries are emitting and which aren't. Maybe not a surprise there. Uh, but there's also within each industry, in some of these high emission industries, there's actually really big dispersion. So there are some very low emitting utilities and low emitting transportation companies. There's a big spread here in corporate carbon damages. Okay, so that's quite interesting. What's going on here? Who are these firms on the low end? Who are these firms on the high end? What are they doing? What's going on? This type of thing could be useful to know about for investors optimizing portfolios, for trying to get a handle on risks to companies through their emissions, etc. Okay, now this sample came from 15,000 publicly traded companies. It's a global sample. They used 2019 and 2021 data. But crucially, only 31% of this sample 31% of the companies in the sample disclosed scope 1 emissions directly. These researchers had to actually estimate all of the other disclosures. And they note in almost all parts of the world, reporting is at present still voluntary, lacks independent verification, and or faces no penalties for underreporting. Together, these features raise important questions about the reliability of emissions data that we cannot answer. So we still don't have a good handle on global scope 1 greenhouse gas emissions disclosed by companies with any degree of trust in those numbers. So the information ecosystem is very immature. Let's see. You can also do some calculations around countries and rank countries around their corporate carbon damages. Here's another sort of recent research, some recent research from the finance world about forward-looking carbon damages, and this is a calculation that these researchers call the carbon burden. Now they're looking not at this year's scope 1 emissions, they're actually looking at expected emissions. Okay, so future emissions. Now, where do you get that data? These researchers got this data from MSCI, data provider, that actually looks at companies' own transition plans, their own forecasts for how much carbon they say they're going to emit in the future. They do some of their own assessment of that disclosure and make their own estimate of whether they think that's credible and what they think the sort of real future emissions are for each of these companies. This sample was actually just US firms. But if we take this expected carbon emissions in the future, multiply that amount of carbon by the social cost of carbon, so dollars per ton, and then we get the present value of that, just like we get the present value of a series of cash flows, we can get this current period estimate of future emissions, the dollar value of the externality here. These researchers apply a discount rate of 2%, and they get the aggregate carbon burden of US firms is 131% of the firm's market cap at the end of 2023, whenever this sample was taken. Okay, so really sizable damages. And then, interestingly, noting also this big skewness in emissions is if you look at forecast decarbonization, it's heavily concentrated. So 30 firms in the US account for basically all of the decarbonization that's forecast over the next 30 years. Okay, so lots of really limited data sources. And these are just two examples of a couple of things we can do with something like scope 1 emissions. But of course, the sustainability information world is much, much, much larger. But we can think about the way that firms communicate their environmental or sustainability related information on a couple of dimensions. So this is from a 2017 paper that was thinking about particularly environmental disclosure, but it can be related to other types of sustainability related matters as well. So on the horizontal axis here, we have environmental performance. This is a very simplistic model. It's very reductive, but it'll help us do some thinking about what we're seeing here. So you could have bad firms that are performing poorly on environmental matters, okay? Or you could have good firms that are performing well on environmental matters or climate matters or whatever. And then on the y-axis, you have their communication about what they're doing. So you could have companies that aren't saying much about their activities, or you could have companies that are communicating more extensively about their sustainability related activities. And if we align those up on a 2x2 matrix, we get down here in the left bottom left corner is what these researchers call the silent brown firms. They're not doing much on environment. They have bad environmental performance, and they're not talking about it. Over here on the upper left square, you have greenwashing firms that have bad performance on sustainability, but they're talking about it. So they're sort of talking a good game about what they're doing, but they're really not backing it up with doing anything. Over here is kind of interesting, and this is what these researchers were really interested in, was what they call green hushing, which was companies that are actually performing well environmentally or with regard to sustainability, but they aren't saying anything about it. They're not disclosing much about it. And then up here we have in the upper right, vocal green firms. Okay, so these would be companies that are have a strong environmental performance and they are talking a lot about it. So when we're thinking about mandatory sustainability reporting, one of the intents, at least in some countries, and particularly in the EU, is that disclosure requirements push companies towards the upper right square, towards the good performance and extensive communication. The idea being that as firms start to do that, they have to make more disclosures. They're going to improve their performance so that they can make accurate disclosures. And that pressure will push firms that might today be down here in the silent brown space up to the vocal green space. Okay, that's kind of one of the positive outcomes that could come about through a mandatory sustainability reporting regime. But just last week, we saw an article in the FT about a vocal green firm. This is Ørsted, which is a Danish wind power company. And their share price has really taken a dive since about 2021. Okay, so same in with Germany. The RWE, the German energy giant, said it was going to scale back green projects and instead buy back shares from investors. So this is a very limited case. This is just two energy companies. Of course, the universe of companies is much, much larger, and sustainability is much, much larger. But this is a data point that's important and it's current, and people are talking about this, especially when you contrast this with the share performance of ExxonMobil. Now, ExxonMobil, I put down here in sort of towards the lower left of the chart here, but of course, ExxonMobil is not a silent brown firm. It's a very vocal brown firm. It's almost over the top, in your face brown. But compare its share price performance with Ørsted's share price performance. Okay. Now, I'm not saying this to suggest that companies should be like ExxonMobil and not like Ørsted. I'm not making that claim at all. The situation is complex here. But this is an important data point that leads us to start thinking about the relationship between climate, environmental, sustainability, performance, value, and disclosure. How are these related? And I think that's quite complicated. And I think it's quite an interesting question. And it's very difficult to answer simply. I don't think it has a simple answer. And I think this is going to play out differently across different sectors, different regions over time. Of course, there will be technological changes, policy changes, regulatory changes, maybe changes in customer demand that might shock this quite a bit. Okay, so when we think about sustainability reporting, I like to sort of anchor or connect to the financial reporting ecosystem. This is the most developed form of reporting that we have in the world. We have accounting standards, we have IFRS, we have US GAAP, we have financial statements, we have investors who are the chief stakeholders for the financial reporting process. We have a principle of materiality that underpins everything that we do in financial reporting, which just means if something is important, essentially, if something is important for an investor's decision, that needs to be measured and disclosed. If its omission would change the decision, then that needs to be, whether there's a specific standard about it or not, it needs to be disclosed. But back to the idea of trust that we talked about at the beginning. Do we trust financial statements? Well, we could say that executives have an incentive to manipulate their reports and they have an opportunity to manipulate their reports. And so we have trust enhancement mechanisms that have evolved around the world, like regulatory enforcement and boards and audit committees and auditors and audit regulators and litigation and legal consequences through private channels. All of these things can continuously evolve to enhance our trust in financial reporting. But then companies can also, outside of this mandatory reporting chain, make whatever disclosures they want. So why do we do this? Why do we do all this financial reporting in the first place? Well, the point of financial reporting and the reason why the benefit it delivers that justifies its cost is a lower cost of capital. There's lower information asymmetry among market participants. And that leads to lower information risk, and that leads to lower cost of capital economy wide. Okay, and rich disclosure, trustworthy disclosures are sort of the bedrock of capital markets. So when we're thinking about climate and sustainability information, well, we could think about where does this fit into the financial reporting ecosystem? Should companies be reporting climate and sustainability information? Do they report climate and sustainability information? Well, the answer is they probably should if it's financially material, but they really aren't right now. So prior to about 2017, this is what the sustainability reporting ecosystem looked like. We didn't really have mandatory sustainability reporting standards. There were limited jurisdictional sustainability reporting standards in the EU. There was the Non-Financial Reporting Directive. There was mostly voluntary disclosures, and there were hundreds of frameworks that companies could use, GRI standards or SASB standards or CDP. But this fragmentation of the standard space meant that disclosures were of limited utility. And also, these were voluntary. The level of assurance that was, that was built into this ecosystem was much less mature than what you see in the financial reporting ecosystem. So these disclosures, I think, had limited value. It's not to say they were untrue or the companies that were doing GRI reporting were lying. I'm not making that claim. I'm just saying when you look economy wide, a voluntary regime means, in general, lower information utility for stakeholders. So the thing that changed everything was some urgency around climate. Okay, images like this that basically suggest that even in the best case scenario, we stand a very little chance of limiting global average temperature increase to 1.5 degrees Celsius. So we've passed that. There's little or no hope for reaching that based on the scientific models that we have today. So the connection between climate and reporting was made by people like Mark Carney and others, central bankers thinking a lot about risk. The argument being that climate is a systematic and systemic risk. Okay, we can't diversify away from it, and it's a risk to the global financial system. But by the time global financial stability is affected by climate change, it's going to be too late to do anything. But if we could find some market-based mechanism that market participants could use to insure themselves against climate risk, then that might strengthen the stability of the global financial system to different climate scenarios. But in order to understand the risk, we need transparency, we need good information. And we don't have that. There isn't good information about how climate risks affect businesses, operations, and strategy and future profitability today. So Carney suggested, and others suggested, Michael Bloomberg was another champion of this effort, that if we had mandatory widespread climate-related financial reporting, then that might allow for market participants to adjust their portfolios, to reassess risk, and that could potentially, one, strengthen the stability of the financial system, and two, even reshape the climate path as we have more information about companies' resilience to climate risk. Now, since the that sort of thinking, we've now got sort of this global set of sustainability reporting standards that are being developed or are developed in some cases. And this is kind of the summary at a high level of kind of the biggest players in the global sustainability reporting space. Okay. I'm not going to go through all of these right now. We're just going to talk really quickly TCFD, and then I'll talk about the EU's sustainability reporting standards. The TCFD is what came out of Carney and Bloomberg's thinking about climate-related financial reporting. So that's been around since 2017. Some companies adopted it voluntarily. Some exchanges adopted it. Some countries have adopted it. And the other sets of global standards have incorporated TCFD disclosures into their reporting standards. So that type of reporting is going to be mandatory in many, many parts of the world outside of the US very soon. And it is already in some areas. But that's limited to climate, and it's limited to what is financial risks and opportunities to a company from climate change. The EU's approach is quite different. The European Sustainability Reporting Standards that came via the CSRD, the Corporate Sustainability Reporting Directive. Okay, those are the main acronyms we want to talk about related to the EU. So we have final standards now in the EU, and they differ from what we see in the other parts of the world. One, legal authority. So the EU has the authority to pass a law requiring these disclosures, and indeed they have done so. We also know what companies are in scope to report in the EU under their standards. We know their perspective on materiality, and we know the topics that are being covered by these sustainability reporting standards. So I want to start with materiality. This is an area where the EU has taken an ambitious approach, is quite bold. Materiality in the EU sustainability reporting standards is what we call a double materiality perspective. So something is material if it's material from a financial perspective, which is what we think of from financial reporting, something that's financially material for an investor's decision. But it also can be material from an impact perspective, which has to do with the company's impact on people and planet. That's the double part of double materiality. So that's going quite a ways beyond the simple or the more traditional financial reporting style of materiality. Okay. We haven't really seen widespread mandatory double materiality sustainability reporting standards before to the scale that we're about to see them in the EU. So it's quite difficult to say how this is going to shake out or what this is going to do, but the intent here of these standards, based on what you see here about double materiality, is one, to get information to investors who want information about financial risks from sustainability matters, and two, get companies to take seriously measuring their sustainability related impacts and do something about them, disclose them. And through this transparency and accountability, there's pressure for them to do something about these impacts. That's the idea. The topics from the EU, so they've got two standards that are kind of general disclosure standards, the conceptual framework type stuff, and what we mean by sustainability and general sustainability process disclosures and quantitative disclosures. They've got environmental, social, and governance related disclosure standards as well. So you could go download the EU standards. They're 300 plus pages, great reading, really fascinating, really detailed. There are quantitative data points like scope 1, 2, and 3 greenhouse gas emissions in the climate change standard. There are a lot of narrative, qualitative disclosures talking about processes, talking about governance. There's a lot there. It's ambitious from a topic perspective as well. The scope of companies reporting in the EU is going to start next year, 2025. So we're going to start seeing EU sustainability reports under the new set of standards in 2025 on 2024 results. And this is going to focus on large companies in the EU that are already reporting under the non-financial reporting directive. And the scope widens out to subsidiaries. So non-EU companies, subsidiaries will need to do reporting under the EU standards. Okay, so you could have a company that's not headquartered in the EU, doesn't have securities listed in the EU, but if they have large subsidiary in the EU, they're going to need to do subsidiary level reporting under the EU standards. Scope widens farther the following year to some SMEs, and then the scope widens quite a bit. So the intent right now is for 2029 to require enterprise level reporting or group level reporting for non-EU entities that do significant business in the EU. So going beyond just requiring EU subsidiaries to report, requiring the group to report. Now, the EU is still working through exactly what those standards will look like. They're going to be a little bit different than the standards we see for EU companies. The topic coverage is going to be pretty similar, but it looks like companies are going to be doing impact only reporting. So non-EU companies that are doing 150 million in annual revenue, and they have a large subsidiary of 40 million in turnover in the EU, are going to be doing impact report, not financial materiality, sustainability reporting, but the impact side. Okay, so watch that space. That's still developing, but ultimately the standards are expected to apply to about 50,000 companies. So I've been working with a lot of companies over the last few years, getting ready for sustainability reporting requirements, and I've been working with boards, CEOs, CFOs, through FDs through sustainability officers, CSOs to more junior staff to in financial reporting and systems, whatever. This is a survey from PwC that tries to get at how companies are sort of feeling about implementing the CSRD and what the challenges are in implementing this. So this visualization here ranks sort of chief obstacles that companies say they're facing as they implement the CSRD. So maybe not surprisingly, data availability and quality is the biggest one, and 59% of respondents say to a very large extent that's an obstacle. So there's a lot of new data that's required to meet the disclosure requirements here. Okay, so even scope 1, 2, and 3 greenhouse gas emissions for the climate standard is a challenge, and that's going to require some significant data availability. But a lot of these items are related to the value chain as well. So in mainstream financial reporting, we think about, the organizational boundary is really, it's really tight, right? So the things that get reported are really inside of the organization for the most part. to do an annual report, right? Most of that data lives inside the organization. You might need some stuff from outside, right? Some actuarial assumptions or whatever, but for the most part, it's firm data. But not so with sustainability reporting, because companies need to report lots of value chain data, so data from customers and suppliers. So value chain complexity is another big obstacle to meeting this type of disclosure. So, if you are a company with 20,000 suppliers, and you need to make some disclosures about forced labor in the value chain, how you're making sure there's no forced labor, or how employees are treated fairly in the value chain, then that that's quite a challenge to get all that data integrated. Capacity, deadline, systems, budget, all these are challenges companies report as they try to meet this requirement. This one's interesting. So this is the respondents here are like CFO type, CEO level respondents to this survey. And this question is, how confident do you feel in your company's ability to meet the reporting requirements of the following topics? And there's quite a lot of confidence here coming out of these respondents, actually. And having worked with teams lower in the organization, FD and below, I can tell you that if they had asked that level of employee how confident they are, the answers would have been quite a bit different. So we're getting a lot of confidence in things like own workforce disclosures. That's like gender pay gap, health and safety, diversity, equity, inclusion, that type of stuff. Business conduct, G1, that's like anti-bribery, anti-corruption policies. Climate change, this is an interesting one. 94% say they're confident in their ability to meet reporting requirements under the climate change standard. I mean, that one, we'll see how that goes. I think that companies will be able to put out reports that look reasonable, but are they really good? I'm not sure. Down at the bottom is this one, an interesting one: biodiversity and ecosystems. Okay, so that is that's going to be quite a challenging one, actually. So it makes sense that it's down there where more companies aren't feeling as confident about it. That one has to do with the company's dependencies on nature and ecosystems, and its impact on nature and ecosystems. That one is lagging behind climate reporting, in part just because I think one, sort of popular awareness of climate has just been higher. It's been more prominent. We had the Paris Agreement, right, and Kyoto before that, but we can't point to something related to biodiversity and nature that's sort of as top of mind as that is. And it's also more difficult to wrap our heads around, because in the climate space we have greenhouse gas emissions, which is kind of the metric that we've been using for decades, that we all agree is a measure of impact on climate change, but we don't really have a tidy metric like that on the nature and biodiversity side. So it's a bit more complex to measure. A couple of observations I have from working with companies that have been doing these disclosures, getting ready for these disclosures, is one. I've seen some companies that have a difficult time really understanding how significantly the world is changing, how different the style of reporting is, and how different the ecosystem is going to be around financial reporting. I think it's a really new environment, and I know there are companies that aren't quite ready, not just from a data perspective or a compliance perspective or meeting the minimum whatever disclosure, but they aren't necessarily prepared for the multi-year journey, and the new era of transparency and its implications. Another one is materiality, is measuring impact. How do you tell if an impact is material? That's a difficult question. And that's something that regulators and companies are sort of working out in real time. Another challenge, another risk that I'm seeing from a lot of companies is to do a CSRD report. It's not just a carve out for the finance team. It's not just something the CFO runs with their team. It's an enterprise wide and indeed a value chain wide exercise. And so there definitely need to be finance and accounting people in this space and sort of working on this as a key stakeholder here. They understand reporting, they understand measurement, they understand systems, but it's going to take people from operations, supply chain. It's going to take people from marketing. It's going to take legal. It's going to take risk management. It's a really interdisciplinary task. And it can be challenging, one, to get the right people in the room, and two, someone's got to own it. Someone's got to be accountable. And who is that? Um, there's a lot of qualitative narrative disclosure in the standards, and there's a lot of quantitative disclosure in the standards. So getting used to this new sort of increase in both types of disclosures, but really lots of talking about process and lots of talking about narratives. Again, I think the failure to understand the multi-year journey that this is going to be. This is we're in this for the long haul. We're in early days of this, and it's going to be more than a decade from now. We're still going to be talking about how quickly things are changing in all the elements of the sustainability reporting ecosystem. Okay, but there are benefits too. So we've been on the risk side here and the obstacle side of implementing CSRD, but what about the opportunities? Um, and the PwC survey asked about this as well. So what do you think are the benefits of CSRD implementation for your company? Better environmental performance. Okay, so a little more than half of respondents think this is going to lead to better environmental performance. I think it might be a little higher than that in reality that we see. There might be some that don't think so today, but we'll see what happens in a couple of years. And this is that shift upward into the performing better and talking about it space from that 2x2 matrix. Improved engagement with stakeholders. So part of the disclosure requirements is to talk about your process for engaging with stakeholders. That's a key step in the sustainability due diligence and materiality assessment process. Risk mitigation, better social performance, etc. On and on and on. Down at the bottom, interestingly, the very last ones, revenue growth and cost savings. So a minority of companies are envisioning sort of improved financial performance on the revenue or cost side from this reporting regime, which is also kind of interesting. I think we're going to have some increased focus on that. Okay, I think we're going to have some increased time and attention on the part of boards and C-level officers to identify sustainability related improvements that are value creating. That's a challenge, but that's the direction I see the focus going. Okay, so we're going to have hundreds of new sustainability reports out in the EU in early 25, and I can't wait. I blocked off an entire month in my calendar to just read sustainability reports. I'm just joking. I haven't done that, but I'd like to do that. But this is a multi-year process. So companies put out their first big EU CSRD compliant sustainability report. But then what happens? Well, there's going to be public critique of these reports. There's going to be a lot of eyeballs on them, not just from investors, governments, regulators, the press, NGOs, activists are going to be looking at scrutinizing these reports, potentially responding publicly to what they see, potentially responding privately to what they see. There is likely to be steering and guidance from regulators as to what they want to see in these reports. There could be changes in this ESG world as new environmental concerns become sort of more pressing, as we learn more about the risk to the planet of the decrease to biodiversity and ecosystems. There's going to be competitive pressure. What happens if you decide in your first year, I'm not going to disclose very much about my sustainability stuff, but then your competitor puts out this lovely, beautiful, detailed, impressive sustainability report? How do you respond to that second year? So firms are going to have to adapt to all of these and update their approach for the second year, and on and on and on and on in this journey. So it's a real challenge. I'm seeing a real challenge from firms, trying to come up with a way to approach their first year reports. And I think they should celebrate getting that first one out. But then, the day after the celebration, get ready to adapt for the year two report. Some people, particularly finance accounting professionals, we really want to do the right. We want to get the right answer. We want to do the right thing. Want to do a good job. Want to get the right report out there. It's really hard to do. And there's no perfect sustainability report out there, and perfection isn't expected. We're sort of building the airplane as we're flying it here, and everybody's developing best practices in real time. This is new for everyone, and incremental progress is expected, and that's part of the intent. I think one of the healthiest thing I see in companies trying to implement this is taking a learning approach here. So, let's learn. Let's use this as an opportunity to learn about these sustainability domains, about climate and biodiversity, et cetera, and learn about the value chain and what's going on, so that we can identify areas where we can strengthen resilience. We can identify impacts that we need to mitigate. And that's scary because a lot of directors don't want to learn about what's going on, because once they learn about it, they're accountable for it. But that's kind of the point of this whole thing. Let's see, let's get that. Okay. Really quickly, I just want to highlight this thing, this idea of the corporate sustainability due diligence directive. This is a different directive in the EU. It's not related to disclosure directly. The CSDDD is a directive that requires companies to do sustainability due diligence. Okay, they now will have a legal obligation. EU companies will have a legal obligation to undertake sustainability due diligence. That is the assessment of impacts they have on stakeholders and on the environment. They also are going to need to have a transition plan, a strategy that is compatible with a 1.5 degrees Celsius global temperature increase. This is also quite ambitious. Again, this is not a disclosure requirement. This is actually a requirement to do the activity of sustainability due diligence. Okay, last thing I want to bring back in here is related to financial reporting. At the beginning, we talked a bit about the financial reporting ecosystem. So we're seeing some feedback here back into the financial reporting system, ecosystem. So what's going on here with financial reporting and climate change? We've seen a little bit of movement from the International Accounting Standards Board, because again, if there are material items related to climate change and climate risk, companies should be financially material items. They should be reported in the financial statements. So last year, the IASB put out this educational material, sort of reminding everyone that whether or not there's a standard about a particular item, if it's material, it should be disclosed. And they highlighted some areas where companies might have financially material climate risks, or there might be areas where climate risk presents particular uncertainties. Okay. Asset impairment, for example, but lots of other things as well. And then last thing, there's actually an exposure draft out that the comment period's closed, but it was actually adding in some examples, some proposed illustrative examples about how climate-related risks might impact disclosures related to different accounting items. So things like credit risk, and this was the example I made earlier. If you have a bank making loans to agricultural companies, and there are climate-specific risks associated with those companies, then that might affect companies, the bank's expected credit losses, for example. So we're seeing some movement here on the financial reporting side from the IASB, independent of but perhaps influenced by the sustainability reporting side as well. Okay, so in conclusion, we're sort of in a high uncertainty environment right now. Lots of things are changing really quickly. Everyone's learning really quickly how to do the sustainability reporting. I'm trying to actively push companies out of the compliance framing for this reporting and into the learning framing for this type of reporting. But this is a really big opportunity for accounting and finance professionals to make a contribution, to their companies, to capital markets, and to society through better sustainability reporting. So just a couple of questions here. We're short on time here, but I'll stick around for a few minutes to answer some questions. One question about the political climate in the EU, sort of things changing, and how does that seem to be impacting the adoption of these standards? So I think the short answer to that question is not much. So in the EU, the directive was finalized. Member states had the opportunity to weigh in before the directive was finalized, but now that it has been, then each member state then has to transpose the EU standards into their country-specific standards, and that's happened in some countries, but it hasn't happened in others. Notably, Germany hasn't done the transposition of the standards, and of course, we know that the government in Germany is in flux at the moment. I think that is a sort of temporary condition. I think the standards they're pretty well set. Now, member states will still be responsible for regulating disclosure of to those standards. So we might see differences in how the French regulator approaches that task versus the German regulator versus the Dutch regulator, etc. So different elements of the ecosystem might evolve differently in different member states with regard to regulatory enforcement, with regard to assurance, etc. So we might see some differences there, but in my opinion, the standards themselves are pretty set. Another question, just about a little more detail about how the EU standards and ecosystem compares with the rest of the world and the US in particular. So outside of the EU, the sort of most influential set of sustainability reporting standards is coming from the International Sustainability Standards Board, the ISSB, which falls under the IFRS Foundation umbrella. So it's sort of parallel with the International Accounting Standards Board. They're different boards that fall under the same nonprofit IFRS Foundation. So they have two final standards out. One is a conceptual framework, a general disclosure standard, and another is climate reporting standard that's closely connected to the TCFD. And they have an intent to produce more standards around biodiversity, around human capital, etc. Their goal as a board is to develop what they call a global baseline for sustainability reporting. So something that's going to have broad appeal around the world. Turn these slides off. Broad appeal around the world, and that countries can build on if they wish to build a more robust financial sustainability reporting or additional sustainability reporting requirements. Those standards are going to be very influential outside of the EU and outside of the US. Those standards are not double materiality standards. Those are meant to be inform investors about financially material sustainability items. China is an exception. So China recently released their sustainability reporting standards. They are following a double materiality framework like the EU, but the length of the standards is scaled down quite a bit. They do have environmental, social, and governance related standards, but they look quite different in scope, in detail, and in spirit than the EU standards. It's worth a look at those. And then in the US, the short answer is nothing's happening. At the federal level, at least, the SEC, United States SEC, had adopted a climate reporting rule that was going to require companies to make Scope 1 and Scope 2 greenhouse gas emission disclosures, not Scope 3, and some other climate-related disclosures similar to the TCFD. But that was challenged in court, and the SEC sort of pushed pause on that rule while the challenge works its way through the court system. So nothing's happening on the federal side in the US. However, some states have taken it on to require companies that do business in the state to make climate related disclosures. So California, for example, companies that do business in California, whether they're US or outside of the US, need to make TCFD aligned disclosures. Now, is there going to be much of a penalty for that? Is that going to have teeth? Is that going to do anything? We'll see. That remains to be seen. So that situation is developing, but I don't see the U.S. adopting, at least at a national level, these types of reporting standards anytime soon, at least not in the next 4 years, and probably longer. Okay, so thanks for attending tonight, and thanks for your questions. I hope you found this interesting. And if you're interested in connecting on the Executive Master of Accounting program, then the link is there in the chat to our webpage. There's you'll see a link there. If you'd like us to arrange a one-on-one session, conversation about the program and how it might fit with your interests and your goals, there's a place on the website there where you can submit a CV and we can reply to you and arrange a time to have a conversation. And I highly recommend that as a great way to engage with the program because it is pretty new. It is a unique program. And it's important to to do your own due diligence on if a program like this is for you, and we can help talk you through some things and help you connect you with alumni and students so that you can learn about what we're doing here and see if you want to be a part of it. Okay, thanks again, everyone, and hope to talk to you again, and have a great evening. Thanks so much. Take care. Bye-bye.